Welcome to this explainer. You know, accounting gets a pretty bad rep for being this opaque, intimidating sea of numbers. But if you've ever looked at a company's financial records and felt completely lost, don't worry, you are in exactly the right place. Today, we're going to break down the very foundation of accounting, journal entries, and translate them into a simple, highly logical system that you can master right now.
Picture this for a second. You just dropped 20,000 rupees on a beautifully crafted, brand new desk for your office. Okay, you've got the desk, the money has clearly left your bank account, but from a business standpoint, how do you officially prove that this actually happened? How does the business remember this event? Every single business action needs a structured financial translation. Without it, well, you don't really have a business, you just have chaos.
Here's our roadmap for today's explainer. The language of business, meet the accounts, the golden rules, the 5-step Riker method, recording a transaction, and finally, common beginner mistakes.
Let's jump into Section 1, the language of business, translating actions into records.
So what actually is a journal? Well, simply put, it's your book of original entry. It is the literal first place a business transaction gets written down. Think of it like a diary for your business. And just like a regular diary, it's chronological. You record things as they happen, date by date. But instead of logging your daily feelings, you're logging business events using the rules of debit and credit.
And that brings us to the two most famous words in all of accounting. They establish the fundamental duality of business. On one side, we have debit, usually abbreviated as DR. This records an increase in your assets and expenses or a decrease in your liabilities. On the other side, credit, abbreviated as CR. This records the exact opposite, an increase in liabilities, income, and capital, or a decrease in assets. It's a balancing act, right? Every single transaction has a give and a take.
Moving on to Section 2. Meet the accountants, the alphabet of accounting.
To speak this new language, we need to know the alphabet. You're going to encounter 3 core types of accounts. First up, personal accounts. These are exactly what they sound like. Persons, firms, companies, or banks. Think a customer named Rahul or your SBI bank account. Next, real accounts. These represent your assets, the tangible things your business owns. If you can touch it or hold it, like cash, buildings, or hey, that 20,000 rupee desk we talked about earlier, it's a real account. Finally, we have nominal accounts. These represent the intangibles, your expenses, losses, incomes, and gains. We're talking salaries paid to employees or rent for the office. Every single piece of a transaction is going to drop perfectly into one of these 3 buckets.
Section 3, the golden rules, the grammar of business. Okay, if you're taking notes, this is the time to take a screenshot, because these are the absolute golden rules of accounting. The grammar that holds it all together. For personal accounts, the rule is debit the receiver, credit the giver. For real accounts, it's debit what comes in, credit what goes out. And for nominal accounts, the rule is debit all expenses and losses, credit all incomes and gains. Seriously, memorize these 3 rules and you've got the master key to unlocking basically any journal entry.
Section 4, the 5-step RCAR method, your secret weapon.
Now, how do we actually apply those rules without getting confused? Enter RCAR. It's this incredibly handy 5-step mnemonic. Step 1 is R, read the transaction. Literally, just step back and ask, what just happened? Step 2 is I, identify the accounts involved. Remember, there are always at least 2. Step 3 is C, classify those accounts. Are they personal, real, or nominal? Step 4 is A, apply the golden rule for those specific account types. And finally, step 5 is R, record the journal entry. Read, identify, classify, apply, record. It turns a complex task into an automatic, foolproof habit.
Section 5. Recording a transaction, putting the framework into practice.
Let's actually put this to the test with a real-world example, apart from buying fancy desks. Here is a raw, untranslated business action. Paid office rent, 6,000 rupees. Let's hit step 1, read. What happened? We paid rent, which means money left our business. Simple enough. Now, before we hit the next steps, I want to share a fantastic little shortcut trick to speed up your thought process. Whenever you see a transaction, instinctively ask yourself these 4 questions. Who is involved? What came in? What went out? Is there an expense or an income? In our rent scenario, what went out? Cash. Is there an expense? Yep, rent. Answering these questions basically solves the puzzle for you before you even start doing the actual accounting.
Okay, let's run it through our RCAR machine. Step 2, identify our 2 accounts are rent and cash. Step 3, classify. Rent is an expense, so that's a nominal account. Cash is an asset, so it's a real account. Now, step 4, apply the rules. The golden rule for nominal accounts says debit all expenses and losses. Since rent is an expense, boom, rent gets the debit. The rule for real accounts says credit what goes out. Cash is leaving the building, so cash gets the credit. See how perfectly logical that is? No guesswork required.
And that brings us to the final step, record. Look at this perfectly balanced, beautifully formatted journal entry. In the particulars column, you write rent ACDR, and right below it, slightly indented, to cash AC. The debit column gets the 6,000 rupees for rent, and the credit column gets the 6,000 rupees for cash. Oh, and don't forget the narration right below it in parentheses, being rent paid. It's a quick summary that proves the entry is balanced and fully documented.
Let's head into our final section, common beginner mistakes, traps to avoid.
Before you go off and start translating your own transactions, we got to talk about some common traps. First off, whatever you do not debit and credit the same account. It completely defeats the entire purpose of double entry accounting. Second, always identify at least 2 accounts involved. Third, don't confuse purchases with specific assets. If you're buying inventory to sell, use the purchases account. But if you're buying that killer desk to use in the office, use the furniture account. Fourth, remember that cash and bank are real accounts. They are assets. And lastly, always write that short narration. A journal entry without a narration is literally like a book without a title. Nobody actually knows what the story is about.
So here's the big takeaway from this explainer. Master the RCAR process. Read, identify, classify, apply, and record. Journal entries aren't some dark art. They are just a logical, completely repeatable system of translation. If you apply those golden rules with equal debit and credit amounts, you can now translate almost any basic business transaction. You've got the alphabet, you've got the grammar, you have the ultimate framework to track the money, the assets, and the people. So I leave you with this. Look around your own life or business today. What transaction are you going to decode next?